Welcome back, guys. Now we're on to my next favorite subject, the balance sheet.
Balance sheet.
So let's take a look at that balance sheet. I know that a lot of you guys probably know what a balance sheet is. What happens to some of this stuff? I mean, what does the buyer get? What does the seller get? I know it's different on each deal.
Yep.
Let's just kind of go through these things. You got cash on hand, you got receivables, you got payables, you got line of credits in use. What happens to all the variables?
Some owners may have a thin, on a typical business, maybe
I want to keep the cash.
$6-8 million in gross sales, would absolutely have at least $300,000-400,000 in cash. Some businesses I've seen have $1 million in cash. So what would happen to that? If the buyer paid 3 or 4 times cash flow, what would happen to the cash? Basically, that $1 million wouldn't go to the buyer. Typically, you leave what's called a gentleman's leave behind, about $100,000 on a business.
Because the receivables could pay that debt off too.
Yep.
And the owner might want a little, he might want to keep some of that cash, the actual seller.
So in general, a seller keeps all of the receivables on the way out the door, except maybe $100,000, which is a gentleman's leave behind to leave some working capital for payroll for the next 4 to 6 weeks. Not that the buyer walks into some big, he doesn't have any working capital. So next question would be receivables then.
Yeah, so receivables, most of these guys, most construction companies, you guys all have receivables. Some of your receivables are out way too far, and they're hard to collect.
You need a bulldog to reel that in.
But receivables are good.
Yep.
It is money that you can theoretically collect.
Yep.
That's going to obviously be a benefit to the buyer.
Yep.
Correct? They're going to pick up those receivables and take responsibility.
Absolutely.
And there's a value on those as long as obviously the liabilities don't outweigh the receivables.
No question. It depends upon your collection rate. Most companies are 99.5 or 99.99% collection over the last 10, 20 years. They only write off maybe $5,000, $10,000 a year.
So Paul, where's the account? We got a lot of liabilities here. 1.4 million on this one.
Right. This isn't a very healthy balance sheet.
This is not a healthy balance sheet because when I'm looking over here at AR, like accounts receivable,
it's only $45,000.
$45,000 cash on hand, and we got a lot of payables out there. So this company is literally, unless they have a lot of sales coming in, they're going to run into a cash flow problem.
This business, though, has an enormous amount of assets. This is a very intensive asset business.
Now what happens to those assets? Buyers obviously getting the assets, correct?
Buyers take over all the assets, typically debt-free, yes.
So Paul, go ahead and, that's depreciation. This always confuses me. When I know how depreciation works, but when you're selling a company, wouldn't this show an accumulated depreciation, actually a higher depreciation, reduce potentially the sell price in the buyer's mind of the value of my company?
No, you take those assets. What you're trying to get the buyer to pay is what those assets are worth today if you brought them to market.
$250,000 is not indicative of the price or the value today of those assets.
Absolutely not. Nope. It's because the IRS allows you to use accelerated depreciation to
like Section 179.
Yep, Section 179 allows you to,
my favorite tax deduction.
Push the value of the assets down and depreciate them at a much more accelerated rate than the actual useful life of that equipment. Most owners with any substantial assets, substantial meaning over $100,000 or $200,000 or $300,000 worth of equipment, would have an asset list. And on that asset list, you'd have year, make, and model of the vehicle, VIN number, miles, or hours on a big piece of equipment. You'd have the purchase price, which is real easy. Everybody has that in their tax return anyway. And then separate from that, they'd have what it's worth today. And the owner is much more qualified than anybody to identify what the value of a piece of equipment is today based on Blue Book or what you could get.
Some of those assets might actually be used in the business process itself to create revenue.
Yep.
Like some kind of machine that's cutting metal or something else. So it might have more value than the asset itself because it's used in a revenue in a process of creating
But basically
revenue.
what you're trying to arrive to is what is all of my equipment worth today if I brought it to market and sold it with a willing buyer, willing seller. Yep.
Okay. So this number's a little askew right now. We don't have that asset list.
Always lower on the balance sheet than what the value of the equipment really is.
Now it's starting to make sense. Depreciation and assets.
Okay.
What else are we looking at here?
And then the assets. The buyer gets all of the assets completely debt-free. Another big number is line of credit. So in addition to payables to your suppliers, you'd have a line of credit because most people have a $500,000 line of credit, and some people dig into it a little further than they should.
Some people are selling to get that line of credit paid off because they run into a cash flow.
And they sign for it personally. Lines of credit are typically signed Wells Fargo or Bank of America. They sign personally, and you want to be off that when you sell the business. So the way to do that is to take part of the sales price to pay that off, or at the very minimum, get the buyer to assume that debt so that you're off free and clear and you can walk away and not.
So all that's kind of part of the negotiation. So Paul, just to wrap up this chapter, when we're determining to sell our company or we're a buyer looking at buying a company, analyzing a balance sheet is just as important as the income statement.
Yes, it is. Yeah. These are the assets and liabilities. The income statement is the income and the cash flow and all of the money that I make through this business. This business is a goose that lays golden eggs, and those golden eggs come in many forms through all the perks and benefits and medical and the wife's car and all that stuff that we run through the business. Those are the eggs.
Excellent. See you soon, guys.